Welcome. My name's Paul Huggins, the Director of Momentum Wealth Management in Hamilton Chase. I have taken the time and researched back to 1886 to highlight to people and put into perspective of what we're experiencing from a lifestyle point of view and also try to forecast how the future is going to be, where I see things in June, September, December, and for the next 3 to 4 years. The following three charts indicate or demonstrate what's transpired on the local markets and also global markets since 2006. And you'll see that the second chart there is highlighted the stock market since 1900. The positive news about that is that it's produced more positive returns than negative returns. And you'll see there that the US stock returns there since 2008 highlight the last 12 to 13 years. What's important to highlight is, through the research, is that going back to the late 1800s, and we touch on 1915, 1918 to 1945. We then touch on the 50s and 60s. We talk about currency, movements in the markets, and what has happened over the course, particularly over the last 65 to 70 years. What's important to look at while studying the history is that whilst we've moved out of the industrial age to the information age, so the next 20 to 30 to 50 years are going to look a lot different to the past 50 years. And I say that because there's been a huge wealth shift. And we're going through a period now where unprecedented with almost zero interest rates. So the government now has real problems in now making adjustments in the form of monetary policy, which needs to be overhauled from a global perspective, and fiscal policy, particularly in the United States and obviously here at home in Australia. What we're entering is the last phase, and there's normally 7 phases to the long-term debt cycle. Now, I'll go through in the next session next month of how that has unfolded, and also the impacts of this, what has turned out to be a 75-year debt cycle, and the shifts in sovereign, government, corporate and household debt. These particular elements are critical to understand. I remember going back many years ago, I met Harry Dent a couple of times in the United States, and he did say to me, when you can understand the psychology of behaviour of people, you've got a fairly good understanding, and it gives you a very good basis to how to predict 12, 18 months, 2 years in advance. And that's certainly what we're experiencing right now in the marketplace on the this outbreak and this pandemic, COVID-19. This period we're going through, and I wanted to put this and make this message very clear, that the media and the government overall, I think, are grossly mismanaging this process. And I say that because at 52 years of age, I cannot remember where I've seen so much fear in people. And I've put together a link at the end of this presentation for Bruce Limpton, who I found this particular link was most appropriate given the times, and also previous to that will be a link by Ray Dalio, in my opinion, has a better grip on global markets than probably anyone in the world. Currently, unemployment rates as of last week were sitting at 5.3%. There's talk that they'll hit 9%, and I think that again will be inaccurate because I think the figure is a lot worse. And I say that on the basis that the ABS figures that will be reporting from the early March won't capture all of March. That's point number one. The second point is that the people that actually don't qualify for Centrelink, that have too many assets or other forms of income, they also don't get recorded and soaked up with ABS. And then there's also the other percentage of people out there with a JobKeeper package that are virtually unemployed that won't get taken up in the ABS figures. So what does that mean? My research indicates the unemployment figures, real unemployment figures, could be as high as 17%. Now that may sound just devastating, but that's for now. Recorded data will go to probably 9, probably 9.5. We'll see. I think it's going to be, if you look at true unemployment figures now, it's nudging 17%, and will be every bit of that in May, June, July. We'll see where that improves. Moving on to interest rates, well, we can't get much lower, so government adjustment is going to be very, very difficult. People talk about the interest rates. We're getting inquiries all the time about what is value, and I think people need to put that in perspective too. Valuations now are a lot more difficult for the average investor out there. I've been sceptical of valuations for many, many years and been saying publicly that prices on listed securities, certain other asset classes, are grossly overvalued and overpriced. The maintaining of earnings on these companies now at 20, 30, 40, 50, 100 times plus is just not sustainable. And you see the likes of Warren Buffett sitting on $125 billion of cash, not because he's old and slow, it's because he's smart. He's hanging on to those reserves, and you'll never see a man move faster when the market does correct again, and there's a buying spree. So big opportunities in the market. It's not all negative, but the problem is it's extremely frustrating for people aren't reading the facts. There's a lot of opportunity. It's going to be fairly tough the next 4 weeks to 12 weeks, I suspect. Governments cannot afford for a level 3, a level 4, no less, to continue. In fact, as I say a little bit later on in the presentation, a lockdown or a level 3 like this, if it did continue to September, I think you'd see recovery in 10 to 12 years. So I think they realise that, hopefully. I wouldn't go being too... I wouldn't speculate on a vaccine. And I would say that you have to take the view that it's here, no different to influenza. I mean, they haven't even cured HIV. I mean, it's been around since effectively September 1983. I remember when the insurance companies came that made that mandatory for declaration for people to, whether they'd engage in any sexual activity. It's 1983. So, here we are now, nearly 37, 38 years later, and there's still no cure for HIV. So everyone just needs to calm down and get a realisation and start to think. Getting back to equity values, I think it's way too early in my opinion to be jumping in and looking at so-called bargains. I personally am not jumping into the equity markets or any other asset class for that matter. Now the tide's gone out, I can see who is swimming naked, as Warren Buffett says, because now it exposes balance sheet and profit and loss, and I get a good understanding of where corporations are. What is value? Well, that's the business I'm in, and I've got to tell you now is that I feel like I've got an X-ray machine on everything, because a lot of companies, a lot of assets and governments have been exposed. So I wanted to leave you with that note. We'll be running the next section next month. I hope you enjoy the presentation. I'm about now to continue on and spend another 10 minutes on why the stimulus package will fail, and to give you an optimistic view on how to handle yourself, your family, your lifestyle and your finances over the next 6, 12, 18 months. I must press that it is imperative that you watch the two links, one with Ray Dalio and Bruce Limpton, the best commentary I've ever seen in relation to what is happening, what is real, and hopefully that'll give you some comfort when you put your head down at the pillow, that life will continue on. Probably the two most respected guys I could possibly find. I hope you enjoy it. I'm going to spend a little bit of time going through the stimulus package, and we'll see, and I'll speak with you, and you'll be hearing from me next month. Thank you.
The important message for everyone on this is, well, giving them some comfort, if that's the term, about, or at least landscape, or to navigate them so they can understand what to expect in the event with lockdown, what they can expect for lifestyle, what they can expect financially from an economical point of view, and when. So I think it's going to be a fairly challenging period between now and certainly August. Anyone that's talking 3 to 4 weeks is I think that's also hype. The next thing I wanted to talk about is the economical state. That's critical now, getting people back to work. The COVID-19 was a trigger event for other issues that have been underlying for many, many years. And I want to talk about the areas that without COVID-19, that the markets were going to react in a negative way because of what's happening in cycles. We are now entering into the last phase of a 75-year debt cycle. And I'll go into the debt cycles a little bit later, but we're actually heading to the last phase. What we have now is extremely low, record low interest rates, and the banks and the government's now in a position where they can't really adjust rates to ease the market. So the next phase of this session was to really touch on why the government stimulus package will fail. And I say that because in 2008, Kevin Rudd bought out, introduced a stimulus package of $50 billion for the financial services sector, banking and the financial system to be cushioned, and that worked relatively well, other than there are also decisions around that money and the policies and so forth, which we saw $34 billion in mortgage funds collapse pretty much within a period of a month, because they introduced this government guarantee of up to $1 million, which now no longer exists. Well, the government guarantee exists up to $250,000, but it's capped to $20 billion of government guarantee. So it's nowhere near the same shape it was in 2008. Now they're rolling out a proposal of $217 billion stimulus package. The difference between this one and 2008 is $50 billion was to simulate the financial system in Australia while people were fully at work, producing in construction, banking, tourism, infrastructure, etc. Now we've got a $217 billion figure, which I still question whether that's real, simulating to the economy while people are at home, when production has dropped significantly in the last 60 days. So what does that mean mathematically? Now, the 2008 $50 billion stimulus package and our economy, if you look at the ASX, took 8 years to recover. Really 8 years to recover. It was certainly before, certainly 6 before we started to see traction. And it was only in recent days that the market retraced back up to, and keeping in mind we're in 2019 before Christmas, before we saw anywhere near 6,700, 6,800 points, before the market corrected in 2008 and dropped to 3,124 on the 9th of March 2009. So now you've got a $217 billion package going into the market while everyone's at home. It will fail. Mathematically, that says to me that that's 16 to 17 times worse than what Rudd did, Kevin Rudd, our Prime Minister at the time, in 2008, while we've got people at home. So the only way that I believe that this will be curtailed is that paying employees an amount of money to keep people at work. My view is the only way that it will work is to focus on monies for people below the poverty line. And I'm talking about, for example, a mother of two, a single mother of two, who at best of times had 28, 30 hours at work and was battling to pay rent. And beyond that, I'm saying that that needs to be that money needs to be deployed in that particular area first. Critical. The second phase is that needs to be focused on the 60, not 65, perhaps 60 plus, with the capacity for ventilators, hospitals, and prescriptive drugs that actually can manage this without a cure for this virus, which I don't think that will materialise. So that would be the first call of deploying the capital. Now I'm saying here, now that's probably 20 billion, not 217 billion. Ridiculous. And then opting to really focus and concentrate efforts on the 60 plus. The third element, or the third deployment of money, which should be focused on employers or employees removing the obligations for corporate tax, company tax, IAS, pay-as-you-go, GST, and payroll tax immediately from employers, and then to be reviewed in 90 days' time. Now, why would you do it that way? Because it can be done instantaneous. I mean, to go and apply now for the stimulus package, it's more work for the employees and the employers to make application for this. And what they've effectively done, the tax system is written in such a way that we've worked hard, collected the money, and we pay and barrel the money to the ATO in Canberra. It'll fail. Make no mistake, it will fail. So I'm a big firm believer. I think the third phase is to cut the tax obligations to companies and to businesses, and then the employer has the obligation to pay the net amount with no income tax obligations to the government. Now, why would you do that? Well, it's mathematically, I've worked that out too. In 2019, up until December, the government raised or pocketed, received $513.5 billion of revenue from Australians. Now what they're saying is, oh, we still want the revenue, but we'll top in $217 billion. Nonsense. If he's real and if he's worth his salt, he should cut off the tax obligations immediately, and we pay the net amount if we want to keep the businesses running. That is a sound way, and I've worked that out, that the budget or the stimulus pack will be around about 100 billion between now and Christmas. That's a smart way to go about that. The way it's going at the moment, collecting all the taxes, and you have to be paying tax to get an incentive. So what you can do, you've got an employee that's on 2,500 a week, and the government's going to give, for no work or limited work, reduced work, and for that the government's going to pay you $750. It'll fail. That's all from me until perhaps next month. But there is light at the end of the tunnel. As far as equity markets, we think that they will be a slow recovery. I don't see a massive bounce in the markets overnight. And I think that even if they found a cure, which is still sceptical, that the recovery is going to be potentially 6 to 18 months before we start to see figures anywhere near what we had in November. And even that's probably optimistic. But that's not to say everyone gets out of equities. That's not to say anyone buys or sells. This is certainly no recommendations being made here at all. But you need to plan for liquidity without drawing on those assets, if you can, for 6 to 18 months without having to affect the sale of any real or crystallisation of any real estate or equities. So I'll leave you with that. It's not positive or negative news. It's very neutral. I've called these markets and made these predictions before and been fairly accurate. I've spent a lot of time on this, and I think what the government's proposing, I think they're reaching. I don't think they've really got a grip on it at all. Financially, I think medically they're doing a terrific job, and we must praise those doctors and nurses and medical assistants out there that are doing just an outstanding job. Financially, the government's management is going to fail. So I hope I'm wrong, but the way it's heading at the moment, if it was a 7 to 8 year recovery from 2008 after the stimulus package, getting the economy back into the black, if those figures are correct, which I still doubt, the economy recovery will be, in my opinion, 15 to 16 years. So that's a wrap from me. I hope you found that informative, and if you've got any queries, you can email me on the below attachment or give me a call anytime. I think it's imperative to call as it is, and I want everyone to wish everyone a happy Easter. And we know you'll be at home. No one's going away. Have a happy Easter, and look forward to talking to you next month. Thank you.